going on, everybody? It's your boy Danny the Bull here with Frankie J Crypto. How you doing, Frankie?
Hey, what's going on, Danny? Happy to be here.
Doing well. If you guys aren't familiar with Frankie, he's been in the Medicaid community since day one. He is big on the macro side of things and has a lot of great information. And one of the biggest topics that always comes up is, when will this cycle end? And no one knows when the cycle will end. So all we can do is arm ourselves with as much information as possible in order to try to gauge where we're at, where we're going, and when things will inevitably turn. So thanks for coming on, Frankie. Appreciate you.
Yeah, of course, man. I'm glad to this is my first YouTube live stream appearance, man, so I'm glad to be breaking it in with another fellow medicator.
Yeah, let's go. We got another one here. Metaboy Chad in the house. What's going on?
Metaboy, what up? Best AI generator in the game.
Great content from this guy. We got Harish in the house. What's good, Harish? ETH 4,500. It's great to wake up to 4,500 ETH. Bitcoin at 119. I put out a poll this morning asking when will the cycle top, and I think it's a small sample size, like 50 people responded so far. It was a few hours ago, but it's telling about where people's minds are, how much people are split on this, right? You got 33% of people said Q4, 20% said Q1 26, 20% said Q2 26, 25% said no effing idea. So everyone is kind of split on this, and I wanted to get your input on it. Now, traditionally and historically, and Bitcoin has been so cyclical, you would assume that the top is coming in Q4 of 2025, because we're about 960 days out from the bottom, and historically it's about 1,050 days or so till we get a peak, which would put us in October-November range. But Frankie here thinks differently, and he's got a lot of compelling data that backs it up. So we're going to go through it, and I'm going to let you share your screen, Frankie, and let you go through some of your data, and we'll pause, whenever to try to break things down and take questions. But go for it, brother.
Awesome. So I think, right, no one has a crystal ball, but I really think that we could very well go into 2026. I think this time is a little bit different, and there are reasons for that. And so there's kind of five reasons, and we'll go through each one, and we won't make it too crazy. Why this time is different? That's institutional flows, institutional adoptions. This is new. This is something that's never happened before in crypto. The BlackRock ETFs, the Bitwise ETFs, Bitcoin and ETH now have live ETFs that are getting a lot of inflows. That is something different. We also have the legislative side of things. Crypto has never had regulatory clarity in the United States. The U.S. is the envy of world markets, and it is so because of their rule of law. And so when the Genius Bill already passed, we have stablecoin clarity, and now we're looking forward to a market structure bill. So we'll cover that. So the legislative side of things, this is new. This is a reason for things to be a little bit different this time. Then we have, and you'll see it on the screen here, the central bank rate cutting cycle that we're still in, and the Fed has yet to pivot. And then on that same chart, you'll see actually it's in brown, or it's in gray rather. I'm sorry. Percent of countries in recovery or expansion stage. That refers to the business cycle, and I'll explain what that is and why that's important. And then also we have quantitative easing, but it's not going to be the central bank QE that we all know and love. And so that's the fifth reason. So institutional flows, legislative, central banks, business cycle, Treasury QE. So let's get into it. So as far as institutional flows, this is something, again, like I said, we've never seen this before. Big institutions are here. They're buying in size. And the reason that this could impact the way the cycle goes is because these guys have a buy the dip mentality. They have a 100-year view. They're not thinking in terms of decades. They're thinking in terms of centuries. And when these guys come in and start buying, it's really going to, crypto hasn't seen these types of flows before. And so it's a steady flow. It's a heavy flow. And it's something that I don't think we're prepared for. And I think that when ETH ETF staking, because BlackRock has told us that they want to enable their ETF holders to stake Ethereum. I don't think that's priced in yet. I think when that actually passes in the SEC, they already had the meeting with the SEC and they've already formally filed. And I think we've seen it before, what BlackRock wants, BlackRock gets. And so I think once the ETH ETF staking comes through, that adds another very compelling reason for, family offices, individual wealthy clients, institutions to come in and really start accumulating ETH in size. So that's the institutional side of things. And there's not really too much to dive into there. It's just the idea is that they're here and they're buying and they're excited about this. And you can also tie it into stablecoins too. I mean, Wall Street really woke up when the Circle IPO. Circle was one of the stablecoin issuers. When the Circle IPO came out and did a 4x, a 5x,
yeah,
it really woke these guys up. And they're like, whoa, wait a minute. Like, what's going on here? Crypto, stablecoin, like this thing just ripped out of the gate. Like, what's happening? And we just got regulatory clarity for stablecoins. We saw $22 trillion in stablecoin flows in the last 12 months. That's bigger than, I think, most anything, really. I mean, it blew some of your more traditional payment rails just completely out of the water. And this is only going to grow. This is only going to expand. And as more stablecoins come onto Ethereum, because I think Ethereum is going to be kind of the big one. I think Ethereum's having its ChatGPT moment. And people are starting to realize that, especially with the SEC Project Crypto bringing the entire financial system on chain, people are starting to realize that Microsoft or that Ethereum is kind of going to be the Microsoft of crypto. They're going to be everywhere. It's going to be the standard for bringing your product, your financial product on chain. This is all in front of us. These are things that are just happening. And so they're moving quick. There's probably a bit of a race going on between companies and eventually between countries to get this ball rolling and to get it rolling fast. So I think ETH has a lot of upside. I 2 months ago, I would have told you a 5-figure ETH is hopium. I think it's definitely on the table at this point. So that's the institutional side. Now, the legislative side, we just got stablecoin clarity, as I said, but what's more important, I think, by leaps and bounds, is the Clarity Act. Complete regulatory clarity, a sweeping market structure bill. And I'll quote Matt Hogan. Matt Hogan's the CIO at Bitwise, one of the ETF issuers. If we get a market structure bill in 2025, it will result in the longest structural bull run for crypto and digital assets that we've ever seen. Again, the U.S. is the envy of world markets because of our rule of law. So if we come into, and I'm from the U.S., so I'm saying we, and so the reason that it's so important for the U.S. to come in and say, we are going to put a rule and a playbook to this thing. All of these companies now in the U.S. can come in. You have to imagine that some companies are probably just holding off because they, right now, we just got out of one of the most anti-crypto administrations and times that you've ever seen. Gary Gensler, Liz Warren, throwing lawsuits at the wall. And now we have a new administration and a new people and saying like, hey, like, we're not going to mess with you. Go ahead and innovate. But it's not law yet. It's not set in stone yet. And so we need that. And so once we get that, it's going to be insane. Like, I mean, we saw the pump in the markets from the Genius Act passing. Imagine the pump we're going to get when the entire industry gets clarity. And we did see strong bipartisan support from this. I mean, the Genius Act got sent to the president's desk with, I think, 102 yay votes from Democrats. And I think the Clarity Act made it out of the House with I think 80 or so yay votes from Democrats. Don't quote me on that. I'm not 100% sure on the last one, but there is strong bipartisan support for both of these bills. And so now that we have one of the most pro-crypto Congress that we've ever seen because of the Fair Shake Super PAC that actually got a lot of pro-crypto Republicans and Democrats into office. And I think Democrats are starting to wake up to the fact that being anti-crypto is not going to gain them any votes. It's not going to help them in any way. And if you're in the States and you live, you can go and I forget the website exactly, but if you go online, you Google, Congressperson, crypto ranking, whatever, it'll show you, like, it'll give you a ranking A to F, what that is, who's favorable or not. If you're in a state where your representatives are not favorable towards crypto, I would encourage you to contact them and tell them that, what the hell are you doing?
I think also, as more time goes on, you've got politicians who are younger and understand it more. The old guard gets kind of like phased out. That's resistant to change and wants to protect the legacy system. And so now you're seeing younger people, JD Vance is like whatever in his 40s, and on both sides of the aisle, you got people who are younger, and that's only going to continue.
Yeah, absolutely. And you see a prime example of that too in Richie Torres. I think a rising star in the Democratic Party, representative from the Bronx, and he's been very vocal. And he's on the House Financial Services Committee, and he was very vocal about the fact that they should be that. He's a Democrat, so he was he's one of the good ones, as we say. So anyway, so there's that. That's the second impetus I think that will push assets higher going into 2026 is legislative clarity. And again, if we get that Clarity Act, oh boy. Okay. So
what's the timetable on that Clarity Act? Do you know by any chance?
I don't know. I think they're estimating a vote for it like sometime in Q4, I want to say. Maybe you could find out more about that. But I do think that they're supposed to have a vote on it, because I think it passed the House and it went to the Senate committee. I don't know, man. It's been a long time since I took my civics lessons.
Yeah,
but I forget exactly how that works. But I know it is slated to, I think, get a Senate vote here sometime in 2025. So yeah. So that's that. Again, that'll be absolutely insane if that happens. And so that's kind of just, that's not the macro stuff really. I mean, it's macro, but it's not like what we think of when we think about macro. And so now we'll get into some of the more heavy macro stuff. And this is where I'll draw your attention to the chart on screen. And we'll go to the third point, which is the central bank rate cutting cycle and the Fed pivot, and really the erosion of Fed independence that I think is coming. I'd argue that it is coming. And so what you're seeing is share of central banks in net easing mode, share of countries in recovery or expansionary stage. So we have 67% of the central banks around the world easing rates, lowering rates. Okay, so that's more liquidity, that's more borrowing, that's more investing, and essentially that's just more capital, and it encourages people to get a little bit riskier in their investment decisions. And then you have 76% of countries in recovery or expansionary stage. That's the business cycle. That's going to be the fourth talking point. And that's really the expansion and contraction of economies. And that's essentially a temperature check on the average investor and how bullish they are or how not bullish they are, and how much money they have to invest. How good are they feeling about their finances, and how much risk can they take in markets? And so we'll get into that. But right now, so we'll go into the rate cutting cycle. The Fed has been stubbornly high. And I think we all know this, right? I would wager that the Fed is going to cut in September. I would say that they very well could cut 50 basis points if we get weak labor market data again, because what we saw from the last labor market report, significant cracks in the labor market. So the reason that the Fed would cut rates is they need to see inflation coming lower, and they need to see labor market weakening. The Fed has a dual mandate, and that is to keep inflation low and to keep jobs high, stable employment, stable prices. And they've been focusing on the inflation mandate. Are tariffs going to contribute to inflation? That's the thing. And they want to make sure that tariffs will not contribute to inflation before they cut rates. And so they've told us consistently they need to see the data from the summer months, June, July, August, before they could even think about cutting rates. And they've been signaling September for months now with that talking point. What we saw, and Powell would always come out and tell us the labor market is solid. If you look at this revision right here, largest revision, I think, since 1958, without a recession. We went from 150K jobs in May and June down to like less than 25 in May, and what is this, 20,000 jobs. This is a huge revision. I mean, look at previous revisions.
How does that happen?
I honestly don't know, man, to be honest with you. The revisions, they always happen, whether it's, an intentional, mishandling of the data. It's actually a good question. I should probably know that, shouldn't I? Like how it is that revisions actually come to pass. But, regardless, the fact is that they did come to pass. And so we are seeing that the labor market is not solid. And so this is going to have the Fed cut rates. And I think the Fed is going to continue cutting rates and moving down the line. And this just shows you too, this is where we were before the FOMC meeting. Powell came out, he got hawkish right here. And so this is the market, discounting the chance of rate cuts in September. And then the labor market revision came out, boom. and now we're up to like a 98% chance of rate cuts. And so that is just that's a big signal. And so what markets are pricing in currently is about 57 basis points of easing by December. I think that they will probably do at least 75 basis points because we have a meeting in September, October, and December. If they cut by 50 basis points in September, which is a stretch, it's a stretch to say that, but that would set us up for at least 75 basis points. But again, I think we're seeing, and this is where it comes into really looking forward into 2026, we're seeing a sea change in the Fed and what their priorities are and how they operate. Now, Donald Trump has put tremendous pressure on Powell, and Powell has done a good job resisting that, but he's only human. He can only take it for so long. And what happened at the last meeting is we actually had two dissents. And so Chris Waller and Michelle Bowman, it is worth noting they're both Trump appointees, but the FOMC, it's not just Powell's decision. It is a vote. They all vote. All the Fed governors vote. And two of them came out and said, hey, we disagree with not cutting rates. We think we should be cutting by 25 basis points. And the reasons they listed were because the labor market's weak and because tariffs do not contribute durably to inflation. It's a one-time price increase, but it's not going to result in lots of inflation down the line. And so now we have a third governor who just got appointed. He has to be confirmed still, but he likely will. Stephen Miran, who is a PhD economist from Harvard. I think he's the head of the Economic Council, one of the economic councils. And he has an idea that inflation targets need to change. The 2% inflation target, a lot of people are starting to argue is arbitrary. The 2% inflation target from the Fed comes from a central banker in New Zealand.
Yeah.
New Zealand? We're talking about the United States of America, okay? And so a 2% inflation target, I don't think it's realistic unless you're going to see inflation. And so I think what's going to happen coming into the 2026, and especially as Trump appoints a new Fed chair, is the Fed's going to get really dovish. And the Fed is going to prioritize helping the government refinance debt as opposed to being primarily focused on keeping inflation and stable prices. And that's what's called fiscal dominance. And we're entering an era of fiscal dominance. And essentially fiscal dominance means, the economy is driven primarily by government debt, government spending, and it's characterized by an erosion of Fed independence. And so, right now, the way that the government is funding the economy is they're issuing short-term debt. They issue treasuries to fund the government. Some of them are mature in 10 years. The debt comes due in 10 years, or sometimes it comes due in a year. The Fed funds rate, the interest rate that the Fed sets, that determines the short-term rate. That determines, the Treasury bill issuance. A bill is a year or less. A bond is anything more than a year. And so when Trump says that Powell is costing us money by keeping rates high, he means that because they're issuing short-term debt and the interest rate on short-term debt is 4 to 4.5%, and the Fed controls that, they're costing them, I think, like $200 billion for every 100 basis points of interest rates. And so Powell actually had this question at the FOMC presser. They said, hey, it's like you're keeping rates high, but this is increasing the interest cost of funding the government because the government's issuing short-term debt to fund it.
He said that wasn't his concern.
Exactly. That's exactly what he said. Yeah, no. And that's going to change. That's going into fiscal dominance is Jerome Powell coming up and saying, you're right. We need to cut rates because we need to help the government refinance debt lower. And that's the era that we are coming into, I do believe, an erosion of Fed independence. And they're going to be more concerned with helping the government print money than they are about keeping inflation and stable prices. This is going to result in a massive asset bubble, a dovish Fed, lower rates, more liquidity, easier monetary policy means assets go higher. And you are going to see a lot of inflation as a result of that. And it is going to be harmful for people who can't afford to save their wealth and assets. It's going to disproportionately harm the people on the lower half of the economy, and it's going to disproportionately benefit the people who can afford to save their wealth in things like Bitcoin and S&P and NASDAQ and gold and silver and whatever else. And so this is a regime that we are coming into. And what I think Trump will probably do is he'll probably name the chair replacement months in advance of Powell's term actually resolving. And so what that's going to do, it's going to create, what Treasury Bissett referred to as like a shadow Fed. And so you're going to have Jerome Powell, who's the Federal Reserve Chair, but then you're going to have, whoever, Joe Schmo, as the incoming reserve chair. And so markets are going to start to take their cue from the incoming chair. And you better believe that Trump is going to appoint somebody who is very dovish, someone who is going to cut rates aggressively. And that's going to be a positive shock for asset prices.
Yeah. So my question is that's going to take place. The switch in Fed chair is taking place in March of 26.
May, I believe.
All right, May. Yeah. So my question is, how much of that is front run, and do we peak well in advance of that?
We could. Markets do price that stuff in, but it's such a big change, and it's something that's not set in stone yet. You know what I mean? Like markets definitely wouldn't have that priced in now. And then I'm not sure they'll have it priced in even by the end of the year, unless Trump actually appoints the Fed chair, or we start to get a lot of clarity and broad consensus around who he's going to appoint, what their policy positions are. Because right now what's going on is Trump is essentially boxing the next Fed chair in. And, and there's this kind of arms race, this dovish arms race to see which Fed governor or which prospective chair, Fed chair can be the most dovish publicly. So if you come out publicly and you say, I think we should cut rates by 50, I think rates should be down to 1.5%, and you say that publicly, it's very difficult to backtrack that when you're actually the Fed chair. And so I think what Trump is saying is hey, if you want to be the next Fed chair, you've got to get up in front of everybody and tell them that you want, such and such dovish policy. So that way you'll be forced to actually enact it once you get in, once you actually get into the position. So I think a lot of that is still in front of us. And that really just also speaks more broadly to all the pro-growth levers that the Trump administration is pulling and are going to continue to pull in order to try and grow their way out of the debt. They're going to try, they came in, they said, we're going to cut the deficit, we're going to cut our way out. It didn't work. And so now they're going to try to grow their way out of the deficit. And I'll quote Darius Dale, who's one of the best macro analysts in the world. This could result in, likely will result in positive shocks to growth and asset prices over the next 8 to 12 to 18 months, and I don't expect that we see a bull run last for 18 months, but, the U.S. government is going to be really, really pro-growth, pro-markets for at least the next year and a half. And I think that will result in at least some price appreciation and some continuation of this bull market into 2026. That's my base case right now, is that we go into Q1. I could be wrong, obviously, but we'll have to see how the next months play out. If Bitcoin hits 200K tomorrow and ETH hits 10K tomorrow, I'm okay, I don't think that lasts, until next year. But so that was kind of the central banks. Again, we're coming into the rate cutting cycle globally. The Fed is set to cut rates here really over the next 3 months. I mean, December could be a rate cut. And then also just the idea of fiscal dominance and the erosion of Fed independence in a very dovish Fed chair that is likely to be, Powell's replacement in 2026.
Yeah, that's all interesting stuff. Do you look, Uno Sean brings up Ethereum over 4,600 here.
Oh my gosh.
Yeah, I think Ethereum's going to at least brush up against its previous all-time high in the next couple of days. If not, I think it'll take a few times to burst through there, but it's looking good.
Man.
Do you, when you're looking at, obviously you're willing to, pivot and change your mind. Do you look at things like, the pi cycle top indicator, or are you going to look at indicators like this, when you're thinking about, have we peaked?
Honestly, I'm not the best technical analyst. I'm not the best on-chain analyst. I'm, more of a macro guy. And so obviously those are things that you should consider as well. But just, from a macro perspective, this is my argument. What's that telling? Is it clearly refuting the idea of 2026?
So basically the pi cycle top is called the last two peaks in, 2021, 2017. It's basically when the short-term moving average overheats and crosses the long-term moving average. Right now, with the way that Bitcoin has been going, you can see that the lines, right, the short-term moving average is still a ways away from the long-term moving average. So actually, if you were to extrapolate that out, and that would assume that Bitcoin continues this type of move up where it has like a leg up and then consolidates for a long period of time and then has another leg up and consolidates for a long period of time. That's what it's done so far this cycle. If you extrapolate this chart out, it actually goes out into 2026. In order to make the moving averages cross and, to signal the pi cycle top, Bitcoin would have to accelerate in a short amount of time, right? And have go a little bit parabolic. And then, that might signal a top. But yeah, right now at its current pace, it's projecting out into 2026.
And just like that, I'm a fan of the pi cycle top indicator. Let's go. That's cool, man. I'm happy to hear that. Doesn't make me look like a complete quack up here. But yeah, man, again, and dude, I think ETH going higher, man, is like, this is just, I think all of the second half is going to be insanely bullish for all the reasons I've talked about. Again, ETH having its ChatGPT moment, institutions are here, ETH ETF staking is coming. I mean, these guys again are thinking 50, 100 years down the road. 4,000 ETH, I think, probably seems cheap to them.
Yeah, and the thing about ETH that a lot of people don't realize is, right now we're talking about staking and we're talking about stable coins, but soon you're talking about the whole stock market trading on blockchain.
Yep.
And that stuff is going to be trading on top of ETH layer 2s. Coinbase has Base Network. So, they have these layer 2s. You say that ETH is old, it doesn't scale, etc. But that's what the layer 2s are for. Coinbase is already signaling that they are moving to be an everything app. That includes tokenization of the stock market. Robinhood already has their product launching in Europe. So you're talking about tokenization of everything is coming. So I think it was B-Dubs asked if you could, I don't know about a six-figure ETH would be like well into the 10 trillions in market cap. That's, we'd have to see where things go down the line, but Nvidia's at 4 trillion. These market caps are going to get bigger as time goes by, and we'll see how high ETH can go. But a 5-figure ETH, I don't think is out of the question.
No, not at all. And again, when you consider like the impetus from stablecoins, and like if we start to see like 100 trillion in 12-month flows, and a lot of that is sitting on ETH, the network effects. Metcalfe's law says that the value of a network is proportional to the number of the users squared. And so essentially what that means is more users, more network effects equals better price. And when you start to consider the insane network effects that are coming for ETH in the form of stablecoins, in the form of tokenization, you have to wonder, like, how valuable can this thing actually go? Because you're talking about the prospect of, and the reason that Facebook and Instagram are so valuable is because of the network effects. It's the prospect that every single person in the world could be on this network. It's unlikely to happen, but it's possible. Like, if you told me that, like, everyone in the world was on Facebook or Instagram or X, like, I wouldn't be super surprised by that. And with the way ETH is going, I don't think it's unreasonable to assume that could be the case in 10 years. That every country on earth, that every trading platform on earth is connected to ETH in some way. That is valuable. Just that in and of itself is very valuable. And so when you think about that, I mean, geez Louise, man.
Yeah, for sure. The long-term vision is starting to come to fruition. You see, like, people like Tom Lee, ringing the bell on Ethereum, 15K this cycle.
Yep.
Those things also, people should be mindful of big numbers. When people like Tom Lee call out big numbers for this cycle, take it with a grain of salt, because you see it last cycle also. I think long-term we will get to a point, as long as ETH maintains its position, where you see a 15K ETH at some point down the line. Doesn't mean it has to happen this cycle, and you'll see a bunch of people call for it. Last cycle, even Raoul Paul called for like a 20K ETH.
Yeah, be careful when these guys, he has, it's his job to be bullish, right? He's got like an ETH like fund now, the same way Saylor has a Bitcoin fund. So yeah, 15K I think is a stretch. I think it could wick to 10K, maybe stop short at 950, 9,500, but it's impossible to say. But long-term vision is clear for ETH. It's going a lot higher.
Yeah. Do you want to continue with your stuff over here?
Yeah, let's do it. So, and again, just briefly too on the central bank side, in 2017 we had a crazy bull run. The Fed was in quantitative tightening, which means they were pulling liquidity out and they were hiking rates. We had a insane bull run in 2017. A big part of it was from China, the People's Bank of China, net liquidity injections. China has been blasting money, and they've injected to the tune of about 10 trillion yuan. And cross-border capital, they're like some of the, Michael Howell is the godfather. He's the one who started cross-border cap. He's the godfather of global liquidity. He's the one who Raoul Paul, derived the framework for his liquidity cycle thesis from. So, they estimate that China has to do that again. They have to print another 10 trillion yuan, which will bring the total amount of money that they printed in 2025 somewhere around the amount of money that the U.S. printed during the GFC, the global financial crisis. So a big impulse coming from there as well. I think one of the reasons we've seen M2 skyrocketing and just global liquidity. Again, 28-day rolling liquidity injections, we're high. I mean, we're up there. You know what I mean? And they've only got to continue doing this. And then you see the connection between, sorry, it's kind of blurry, the connection between Chinese liquidity and world commodity prices. And guess what? The SEC just came out and said that, most crypto is a commodity. So we're looking good. So, and that brings us into the next impetus. So we've got institutional flows, we've got the legislative side, we've got central banks, China, the Fed, and then also the incoming shift in regime change from the Fed, which I don't think markets have priced in. We have the business cycle. Now, the business cycle is the expansion or contraction of the economy. This is the ebb and flow of markets. This is the breathing in and the breathing out. This is essentially a temperature check on how wealthy do people feel, how much work do people have, how many hours do they have, how many jobs are they getting, and how much money do they have, how confident are they in the economy, how much growth do we have. Right now, and we typically see this ebb and flow with the liquidity cycle. It's got about a 4-year cadence to it. What we've seen is not common. This is world business confidence, Europe, America, Asia, and we've seen the lowest amount of business confidence in 10 years except for COVID. And we're creeping up on COVID levels. This indicates to me that we are due for a coiling up. And the connection here between the ISM, which is how we measure the business cycle, the ISM, it stands for the Institute for Supply Management. It's also known as a PMI, a Purchasing Managers Index. And what they do is they essentially give a survey to the world's largest supply chain managers, and they ask them about how they feel about the economy, how are outlooks for new orders looking, how are new hires looking, how are your numbers looking, how's your business looking, and based on that we get a score from 40 to about 70, and above 50 means that we are expanding, below 50 means that we are contracting. You can see what happened the last time that we went into max expansionary phase, when the economy is growing, when businesses are growing, when GDP is higher. We see altcoins rise as a result because the average investor feels more wealthy. They have more money to invest, and this will also coincide with massive increase in global liquidity and just bull market sentiment and kind of just animal spirits in general. People are feeling good about the markets. Markets are ripping. I'm feeling good about my business and my finances. Let's toss a little bit in. Look at where we have been in a minute. It's no surprise to me that altcoins have kind of just been in this stubborn range and just kind of bleeding back to Bitcoin and ETH. Look at where we've been really for the last 3 years. We've just been hanging out around 50, ranging around 50. We're not really in a contraction. We're not really in an expansion, kind of just hanging out. Now, the reason I believe that this is the bear market here. It's kind of the bear market, but this, I think the bull market kind of started with the Bitcoin ETF and Larry Fink starting the bull post right around here. What I think is contributing to a continued delay in the business cycle is the uncertainty of tariffs and trade negotiations. And I hear it, you see it in the data, and you also hear it anecdotally from business owners, especially anybody who deals with businesses overseas. I have a friend in the jewelry business, for example. She was telling me that business is kind of slow. Our overseas business is taking a hit. And she even used the term uncertainty. She's like, it's just a lot of uncertainty right now. No one really knows how to move forward. And so we hear it from CEOs too. We're not hiring, we're not firing. We're sort of just in a wait and see pattern. And so my belief is that until we get tariff clarity, until we get trade clarity, and we know for sure what kind of environment we're going into, the ISM will kind of continue to stagnate like this. And as a result, I think altcoins will be held down. Now, can they do well without this going higher? Of course they can. But when this rips, I think altcoins are going to do this again. And I think tariff clarity is coming, right? Trump's aggressive rhetoric towards China has clearly peaked. We have trade deals now with Japan and Europe who have pledged trillions of dollars in CapEx, which is capital expenditure, essentially investments in the U.S. economy. And again, that's more economic growth, that's more economic expansion, that's more jobs, that's more manufacturing, that's more productivity onshore that is going to drive ISM's PMIs higher. That is going to be a big impetus. And once we get that big China deal and it's inked and we know exactly what we're doing, businesses are going to expand. Businesses are going to start hiring. They're going to stop their hiring freeze. They're not going to be in a wait and see anymore because they've waited and they've seen. And now it is time to act. It is time to act on this clarity and to expand because it's time to expand. And you can see
how much.
right?
Sorry to interrupt.
No,
how much would rate cuts impact the ISM?
It certainly can because, but it would take a little time for it to make its way through. So when they cut rates, essentially what they're saying is that the cost of new capital becomes cheaper. Mm-hmm. The cost of borrowing becomes cheaper. And so it loosens, if you think about crimping a garden hose, you're essentially uncrimping the hose. And so, this will encourage more borrowing and more lending and more spending. But, then people have to go out and actually borrow. And then they actually have to go ahead and receive those loans and then start spending them into circulation. And then, that money has to flow down to, retail and then, back to, manufacturers. And then, it takes some time. And then eventually for the overall inflationary effect for it to have on the economy and asset prices. So it does take some months to make its way through. But, essentially it's a positive shock, it's a positive shock to growth, rate cutting is. So it will be good. It will be good for the business cycle because again, the cost of new capital, the cost of doing business essentially becomes cheaper.
Nice.
Yeah. So yeah, again, I think this is a really big one. I think this is a really big part of why I think 2026 is going to be bullish because we're already halfway through August and we don't have a China deal yet. You know what I mean? And this is going to take time to expand. It's not going to happen overnight. So if we get a China deal by September, we'll start to see this thing really start to tick up over, October, November, which, again, we could peak in December. But again, I think that this 3-year lull, I think this continues to rip. And again, this business confidence low, I think as this continues to rip higher, that takes us well into 2026. And again, the leverage that the Trump administration is pulling to create positive shocks to growth and the CapEx funding that's coming from Europe and Japan, it's going to take some months to really make its way around. And so, yeah, markets could price that in advance and sell off completely, in anticipation of that coming to an end. But again, these positive shocks to growth aren't going to come to an end for at least 8 to 12 to 18 months. And so, how far in advance are markets really going to price this thing out? You know what I mean? And especially as these things develop, you know what I mean? Again, there's still developments yet to come, and so markets don't know what to price in yet. So I still think that this is a big reason why we will rip into at least Q1 of 2026, this business cycle impulse that is still in front of us. And again, whether or not we top in 2026 isn't really super relevant. It's the fact that these are positive catalysts that are likely coming. Institutional flows are coming. Legislative clarity is here in the form of the Genius Act and very likely in the form of the Clarity Act. Central banks are cutting around the world. The Fed is most likely going to cut in September, and we are going to see a very dovish Fed chair get installed in next year. And we are going to have a resolution to the trade uncertainty and to the tariff unclarity. We are going to have that, and we are going to see a positive shock to the business cycle as a result. These are things that are happening. And then there's one other thing. Oh, and this actually tells you too. Just on that same vein, the AI build out that's coming for us is insane. Yeah. AI data center construction spending is almost surpassing U.S. office construction spending. This is another reason that the U.S. economy is about to be ripping because the AI build out is here. The future is now. And that's going to be a major driver of growth. It's going to be a big shock upward for PMIs as well. So another impetus for the business cycle. So the last thing I want to talk about is quantitative easing, QE. everybody wants to know when QE. People have kind of like simmered down about that, but like I remember like in
Yeah,
Q1,
it was
everybody was
big narrative. It was a big narrative months ago.
Yep. And people would often mistake, duration management for stealth QE, which is we can get into that. So anyways, what QE is, quantitative easing, is when the central bank prints currency units or issues currency units and uses them to buy bonds. They expand their balance sheet and they buy the debt. That's how debt gets purchased. You know what I mean? Like we are in a debt-ridden economy, we are reliant on central banks to bail us out. That's the reason they were created in the first place. And so that's what QE is. Now, Powell has signaled in no uncertain terms to Congress that they will not be doing QE until interest rates are at or below zero, which I don't think we'll ever see below zero interest rates ever again.
Yeah, and he said we'd only get there if there was like some cataclysmic event.
Exactly. For some reason, you'd want to pay someone to borrow money. You know what I mean? So, and so what we're going to see, and what has been clearly communicated to us from the Fed, is that they're going to issue. And so I've talked about how the Treasury is issuing short-term debt. One of the biggest buyers of that debt are going to be private banks. Private banks are going to buy up the short-term debt because they love it. It is good for them. It's quick money. It's quick, easy money for them. And you can see that reflected here. U.S. banks' public debt holdings has been going up only since about the end of 2023. And this right here, this was that run in 20. Remember at the end of 2023, 2024,
yeah,
we had that massive run. This is it right here. This is that run.
The bottom yellow is the run.
Yeah, Treasury agency securities. This is private banks buying government debt because Janet Yellen issued about $7 to $8 trillion in short-term debt during that time, and they did that, I think, to goose the economy to try and get Biden reelected, or Kamala elected, whatever you want to say. And then also at the same time, Powell was cutting rates, and so huge shock to growth, and so this is going to happen again. This right here is going to happen again. We have $9 trillion of debt to refinance in Q3. They've signaled to us that they are going to print short-term debt. Private banks are going to buy it. Now, if you're a private bank and you say to yourself, I want to buy Treasury debt, you have got to have X amount of what's called Tier 1 capital. And that's dictated by what's called the supplementary leverage ratio, the SLR. What the Fed has come out and said, and they've advanced a resolution to get this going, is they are going to adjust the SLR down, which means you don't need as much Tier 1 capital. You go ahead and you buy as much short-term debt as you want. Go ahead and buy as many bonds as you want. So if you're Jamie Dimon, the cuffs are off, the muzzle's off. You can go ahead and you can go crazy. And what banks can do that nobody else can do is they can create credit. They can create, let me see if I know I have the chart. I didn't include it here. Give me just one, if I can just quickly.
Yeah, go for it, brother.
Brush through my charts and see if I have it. I don't. But what the chart basically is telling us is it shows that, and this was back in October. I've been screaming about this since October. Hose V, yeah, we're going up, brother. What private banks have been doing since October is they've been increasing credit creation. That's how the banks are going to buy this debt. They're going to use it with credit. Because again, they can use the multiplier effect. You deposit $100 in the bank, they keep 10% and they lend out 90. The next bank keeps $9 and they lend out 81. And so from $100, they have created $171 essentially out of thin air. Now you do that over the course of several times with hundreds of billions of dollars, and you've got yourself a shit ton of money. And so that's a scheme. Oh yeah, 100%. And that's how they're going to do it. That's how they're going to buy this debt. And private banks are the only ones who can create credit like that. And so they're going to use credit to buy bonds. And the chart that I wanted to show you shows that as the Fed stopped cutting rates, private banks created more credit. And so it was a textbook handoff. Banks, the central bank can afford to stop cutting rates as monetary easing flows through to private credit creation, textbook handover. And so that's the plan. That's the QE. The QE isn't the central bank printing currency units and buying bonds. QE is the Treasury issuing short-term debt and private banks buying it. And they're getting the blessing from the Fed in the form of the SLR coming lower so that they can buy more debt.
Has that started yet?
No, I do not. I mean, I'm sure the banks, I mean, you can see this right here. They've started, in 2025, they've already started buying more. But in terms of the SLR actually getting adjusted lower, I don't think that's happened yet. So that is still in front of us. And I'll quote Andreas Steno Larsen, who is one of the partners at Real Vision. Raul Paul actually just bought his company and absorbed him and his partner and brought him onto Real Vision. That's going to be equivalent to several months of peak COVID QE. So the quantitative easing that we saw in COVID, the peak of that, several months of that, that's what the SLR, that's what this Treasury QE is going to bring for us. And so that is still in front of us. That impetus is still in front of us. And I'm not sure when exactly they'll get that rolling. But again, they have all this debt to refinance in Q3. We're coming up at the end of Q3. And so, we've got about another month and a half for them to make that happen. And so that is the fifth and final impetus at the end of what has been a lengthy presentation here. But yeah, so I mean, just to wrap it up, just to summarize again, there's 5 things that I'm looking at, positive catalysts that I think will take us into 2026. It might not, but I think the most important thing to take away from this is that they are coming. These are positive catalysts for risk assets and for crypto specifically, institutional flows. This is new. This is different. This is what we've never seen before. We have legislative clarity coming. This is new. This is what we've never seen before. Then we have central banks cutting and a change in regime, which we've never seen before. We've never seen a lack of Fed independence, which I really do think is coming. And then we have the business cycle coming up. And to be honest, I mean, this right here, we haven't seen that. We haven't seen this in I don't think in a very long time. Really the lowest rates we've seen in quite some time. And then we have Treasury QE, which is going to be a big impetus. And then I just have some other charts here just in case we got into other stuff. And you can see it right here too, like the growth of Fed liquidity is trending down. They're not going to be the ones to buy the debt. The public and private banks are going to be the ones to do it. The private banks are going to be the ones to do it. So I'm bullish, man. I'm really effing bullish.
Yeah, it's really interesting stuff. And if, for people who think that it can't be different this time, I mean, it was different in terms of Bitcoin hitting a new all-time high before the halving, which speaks to the institutional money coming in that you had talked about earlier and how that already changed things. And sometimes when I think I'm torn, right, I don't know when this thing is going to top, I don't think anyone can really say, but I'm open to the idea of going longer. And sometimes I think maybe right now we're in like that 2020 phase and the tariff, noise and news was our COVID event that caused things to bottom. And now we're, coming out of 2020 and then going next year will be 2021. But it's hard to, right? And we have to let. You there, Frankie?
Yeah, sorry. I had just a massive surge of lightning kind of. What was the last thing you said? I'm sorry.
I said, yeah, no, I just said maybe next year, maybe right now we're in a similar time to 2020. The tariffs were kind of like the COVID low of 2020. And now we're about to head into 2021. 2026 is our 2021. But we have to play the games. Like we have to wait and see how things turn out.
Yeah, 100%, man. I think fundamentally this market has been pushed out. I think it's been pushed out to the right. I think tariffs and all that was a big part of that. I think that essentially stalled the traditional cycle. I think short-term debt issuance, kind of interrupted the traditional 4 to 5 year cadence of debt refinancing, because this is what, this is actually what drives economies and drives markets is liquidity, and it's this 4 to 5 year cadence of debt maturing and central banks rushing in with liquidity to refinance it. That's what drives assets higher. And so fundamentally, this stuff has been pushed out a little bit because we've never really seen the economy of the U.S. economy issue so much short-term debt. Usually they term out their debt over the long term, 10, 30 years. And so the 1 year, that all that debt they issued, that 1 year debt that they issued, that's coming due at the end of Q3 when it normally wouldn't have. That normally wouldn't have been a thing. So yeah, I think fundamentally we've been pushed out, and I think we've just been shifted to the right a little bit. And I think it was done intentionally. I think Trump intentionally came in and kitchen sink the economy to create a lower comparative base, and then also to rally markets into midterms.
Yeah, that Darius Dale, I think, said this in December of last year. I think he was like the first person to talk
Yeah,
about
yeah,
the kitchen sink theory, and which Reagan did, right? And
yeah, absolutely. Yep.
come in, tank the economy, and have a lower base to then spring into midterms in 2026 to get people elected.
100%, 100%. And those executive summaries from Darius were one of the big reasons I was able to stay calm. During all the the bloodshed that we saw over the first 4 or 5 months of the year, and it was one of the big things I was telling people, who were kind of panicking. I was like, listen, guys, this is by design. He's going to rally markets into midterm. Don't sweat it. They have a lot of levers that they can pull, and now they're pulling them. And they're pulling them fast. I don't know if you've ever seen that video of that guy like playing that like crazy piano thing where he's like got like the bike horn and like he's pulling like the whistle and like he's got the piano. It's like just a hilarious contraption. This guy's like doing 100 different things. And so that's the U.S. government right now pulling levers to send the economy, I think, into an absolute mega frenzy of growth.
So to circle back to the initial question, do you think the 4-year cycle is dead? It's done?
I think there's a strong component I think there's a strong reason to understand why. A strong reason to believe that the 4-year cycle has shifted. I'm not going to say that it's dead, but I would say that I think it has shifted this time. And in terms of 80% drawdowns, I don't think we'll see those because these big institutions are going to come up and buy the 40 to 50% dips, and so they're essentially going to stop that 80% dip before it can happen because they're going to come in and buy the 40 to 50% dips because these guys operate differently. They operate differently than retail. They see a 40% dip and they're all in because for them, they're looking 50, 70, 80 years down the line. And we're maybe looking, 10, 15, 20 years down the line.
The other question I wonder is, maybe they flush it low so that they can scoop up more.
It is possible. It definitely is possible. But, I'm taking that talking point from Matt Hogan too. He's again, the CIO of Bitwise. That was his argument as if when we see these dips, they're not going to wait for 70, 80%. They're going to come in and swoop at about 50%. So I think a lot of the sell pressure will be absorbed really, before we get to like these crazy, 70, 80% drawdowns.
Yeah, I do think, as time goes on and Bitcoin becomes more mature, just like you have diminishing returns, you'll have diminishing losses, right? And it won't dump 90%. Even last cycle, I think it dumped 78%, which was a lot. But if you compare it to previous cycles, it was less. So if we continue on that trajectory, it's only natural that we won't see a 78% dip next time. Yeah.
Exactly. That's exactly right.
Yeah. Well, been on for about an hour now. I want to respect your time. I want to thank you for coming through, Frankie. I think it was informative. I didn't get to talk alts today. I may do that tomorrow. I'll jump back on. I saw people mentioning X, Morphware pumping. Yeah, Morphware pumping today. Some other things pumping. Maybe I'll do a stream tomorrow. We'll talk about some of our favorite altcoins. But today was strictly a macro talk, talking about the cycle, when it might end, and just gaining new perspective. And I want to thank you, Frankie, for coming on and sharing with us. Josh says he learned a lot today.
Awesome. Yeah, man. Happy to be here. Happy to come on. And I'll be excited to come back maybe, in a few months when we have some more macro developments.
Absolutely, brother. Be happy to have you on. Harish says Frankie is good. Yes, he is.
Thank you, Harish. You are good as well.
Yeah, definitely hit him up on X. Follow him on X. He's in Twitter Spaces all the time. Harish says I should bring you on again, so we'll get you on again for sure. Follow Frankie. Give him a follow on X. And make sure you hit the like button on your way out. Subscribe to the channel. I'll catch you all in the next one.